Hi, and welcome to today's webinar on tax implications on employees' tax reporting in the face of COVID-19. By the end of this webinar, we hope that you will walk away with a full understanding on the changes to the tax reporting of employees' income. We will be breaking today's webinar into three main sections. Firstly, we will go through our tax guidance for YA 2021 arising from COVID-19, including its scope and conditions. We will also go through the tax residency of employees, especially those who are temporarily working in and outside Singapore due to COVID-19, as well as the taxation of their employment income. To round off this first agenda, we will go through some examples. Next, especially for employers who are providing employees with accommodation or allowances due to COVID-19, we will be going through the tax treatment for such employment benefits. Finally, we will be happy to take any of your questions or clarifications that you may have on any of these topics. Without further ado, we will jump right into the first agenda on the tax guidance for YA 2021. As soon as the COVID-19 pandemic hit, we saw that there were a number of employees whose employment were disrupted, whether in Singapore or overseas. We observed that there were two main types of employees affected by COVID-19 developments, and who somehow had to return to Singapore or to extend their stay in Singapore. The first group are Singaporeans and PRs who are actually based overseas and working for an overseas employer. But because of COVID-19, they have returned to Singapore and are working remotely here. The second group are overseas-based foreigners who are on business trips to Singapore but were unable to leave Singapore upon the completion of their assignment, which means these are foreign employees who came to Singapore for a business trip but got stranded here. To support them through the evolving COVID-19 developments, IRAS has worked to give them tax certainty on their situation through new tax measures. So here are the COVID-19 tax measures. Looking at this diagram, we have a Singaporean or PR who is working throughout a calendar year. And the full calendar year is represented by this bar graph here. As you can see, for the first part of the year, he is not in Singapore, since he is actually based overseas. But because of COVID-19, he has returned to Singapore and is temporarily staying here and working from home for his overseas employer. So yes, the tax measures that we are about to touch on will cover Singaporeans and PRs like him who have been exercising overseas employment before returning to Singapore due to COVID-19 and who are working remotely from Singapore for that employment. Under our COVID-19 tax measures, his employment income for the period of stay in Singapore up to 31st December 2020 will not be taxable in Singapore if he meets the following criteria. 1. That there is no change in the contractual terms governing his employment overseas before and after his return. Secondly, this temporary stay in Singapore must strictly be a temporary work arrangement due to COVID-19. Let us elaborate on this first condition here a little further. This means that if you have amended their employment contract to say that the employee should no longer be based overseas and is sent to work in Singapore for good, then his income arising from his employment in Singapore will be subject to tax. Since this employee here has met these two criteria, the income that his employer pays him while he is in Singapore will not be taxed in Singapore, since he would have returned overseas if it were not for COVID-19. Now, as for the second group of people, it would help if you looked at this graphic here. As you can see in this graphic, if a non-tax resident foreigner has worked for 60 days or less in Singapore, that income will be exempted from tax under normal tax rules. However, due to COVID-19 related travel restrictions, the foreigner's stay in Singapore was extended beyond the 16 days. So you would have to imagine this blue bar here as 60 days plus an extended period of stay, which could be a few more days or a few more weeks. Indeed, the COVID-19 measures will also cover this group of non-resident foreigners who have been exercising overseas employment and are here only for a short-term business assignment. Due to COVID-19 travel restrictions, they have extended their stay in Singapore, but they are still working here for that overseas employment. Under the COVID-19 measures, they will not be considered as exercising an employment in Singapore for the period of their extended stay if they meet two conditions. Firstly, the period of their extended part of their stay should not be more than 60 days. Secondly, the work done during the period of the extended stay should not be connected to their business assignment in Singapore, meaning it should be work that they would have performed overseas if it were not for COVID-19. If this has been a lot to take in, don't worry. We will be illustrating with some case studies in subsequent slides. For now, we will move on to the next agenda, which is a recap of normal tax rules on the tax residency of individuals and the taxation of employment income. For tax residency, we have to go by the statutory definition in the Income Tax Act. And according to the Act, there are two tests to determine the residency of an individual, which are a qualitative test and a quantitative test, as depicted in each of the two bullet points here. Under the qualitative test in the first bullet point, an individual will be treated as a tax resident in Singapore if he or she normally resides here, except for temporary absences. As for the quantitative test in the second bullet point, an individual will be regarded as a tax resident if he or she is physically present or exercising employment in Singapore for 183 days or more in that calendar year. A simple way to remember the quantitative test is that there are 365 days in a year. So if the employee has been staying or working in Singapore for more than half a year, which is about 183 days, he or she can enjoy resident tax rates. In this graphic here, we see the quantitative test at work. Based on our visual estimation of this blue bar here, we see an employee who has worked in Singapore for more than half the year. Can this employee enjoy resident tax rates? The answer is yes, since he has exercised an employment in Singapore for 183 days or more. To reinforce our understanding of these quantitative and qualitative tests, we will provide an example for each. For the first example, well, we may know of many Singaporeans and PRs who are exercising overseas employment the whole year round, like this employee here. First of all, based on the first qualitative test, Singaporean and PR employees will generally be regarded as tax residents since they are residing in Singapore. However, if they live or are based overseas for the whole year, like this employee here, IRAS is prepared to assess them as non-residents. This means that should they be earning any other income in Singapore, such as rental income, this Singapore income will be taxed based on non-resident tax rates. For the second example, we will apply the quantitative test. The quantitative test will apply to foreigners, like this foreigner here. Foreign employees will be regarded as a tax resident in Singapore if they are physically present or exercising an employment in Singapore for 183 days or more in a calendar year, as you can see in this graphic here. Conversely, if their stay or length of employment is less than 183 days, IRAS will assess them as non-residents, which means they will be taxed based on non-resident tax rates. Next, we shall move on to what will be taxed under normal tax rules. Employment income will be taxed in Singapore as long as it is accrued or derived from Singapore. Employment exercised in Singapore will be deemed to have been derived from Singapore. So, an employee whose employment is based in Singapore will be taxed on his employment income. An employee who is based overseas but is here on short-term business assignments would be taxed on the part of his employment income relating to his business assignments here, unless specifically exempted. For Singaporeans and PRs who are working overseas, employment income from overseas employment will not be taxed in Singapore, even if this is paid to a Singapore bank account. For non-tax residents, such as foreigners, who are on a short-term business trip to Singapore, well, you will have to imagine on this graphic here that this blue bar depicting the length of stay or employment in Singapore is 60 days or less. If the period of stay or employment in Singapore is 60 days or less, that employment income will be exempt from tax, because these are short-term and temporary stays. If the period of stay and employment in Singapore is more than 60 days, up to 182 days, that employment income of the foreign employee will be taxed at the flat non-resident tax rate of 15%, or resident tax rates, whichever is higher. So you may ask, why stop at 182 days? Well, if we bring you back to the graphic for the quantitative test, if a foreign employee is physically present in Singapore for 183 days or more, he or she automatically qualifies for resident tax rates. With these concepts fresh in our minds, we will now go through some case studies to see how the COVID-19 tax measures can be applied. Let's first meet Andrew here and go through his situation. As you can see in this graphic, Andrew is temporarily in Singapore, and let's find out why. Andrew is a Singapore citizen who has been working overseas since 2017. Due to COVID-19, he has returned to Singapore in April 2020 and stayed here for 180 days. While in Singapore, he continued to work remotely for his overseas employer. This was a temporary work arrangement due to COVID-19, and there was no change in his terms of employment before and after his return to Singapore. In this case, would Andrew qualify for the COVID-19 tax measures? The answer is yes. You can see that Andrew has met the two qualifying criteria for the COVID-19 measures in the third and fourth bullet points, which are that this is a temporary work arrangement due to COVID-19 and that there was no change in the terms governing his employment overseas before and after his return to Singapore. Since Andrew is only in Singapore temporarily due to COVID-19, he will be treated as a non-resident for YA 2021. Since he qualifies for the COVID-19 tax measures, Andrew will not be considered as exercising an employment in Singapore for his stay in Singapore, and thus his income will not be taxed in Singapore. Now you may wonder, what if Andrew had been to Singapore a couple of times before, in the early part of the year, for short business trips? How then will the tax treatment be different? In this graphic here, we have added two small blue stripes depicting two short business trips to Singapore that Andrew took in the early part of the year, which totaled 40 days. So here we have another Andrew who is a Singapore citizen who has been working overseas since 2017, which means he is considered a non-tax resident. He made two business trips to Singapore before April 2020, which totaled 40 days. due to COVID-19, he returned to Singapore on 1st April and stayed for 183 days before returning overseas for work. While in Singapore, he did continue to work remotely for his overseas employer. The work done during his stay in Singapore was also not connected to any business assignment in Singapore and would have been performed overseas if not for COVID-19. Well, in this case, would Andrew qualify for the COVID-19 tax measures? Would he be considered a tax resident since he would have qualified for the 183-day rule? Well, firstly, we will look at the two trips separately from the longest stay, because these two business trips to Singapore at the start of the year are short-term and incidental to his overseas employment. So those two business trips will be subject to normal tax rules. As for the longest stay, we need more information. Firstly, is the work that he did in Singapore related to any business assignments in Singapore? The answer in Andrew's case is no. The work that he did in Singapore is not related to any business assignments in Singapore and would have been performed overseas if it were not for COVID-19. The second qualifying criteria is, were there contractual changes to his employment terms? The answer in Andrew's case is also no. There was also no change to his terms of employment overseas before and after his return to Singapore. So Andrew has satisfied the two qualifying criteria with the last two bullet points with regards to his stay in Singapore due to COVID-19. So the answer is that IRAS will continue to assess Andrew as a non-resident for YA 2021 because he is based overseas. If it were not because of COVID-19, he would have returned overseas and continued working overseas for his overseas employment. Andrew will also not be taxed on his employment income during his 183-day stay from 1st April, as he will not be considered as exercising an employment in Singapore during that period. As for the two trips to Singapore at the start of the year, we consider these trips short-term and incidental to his employment overseas, and are thus subject to normal tax rules. Since the assignments were for a period of 40 days, which is not more than 60 days, that employment income will be exempt from tax in Singapore. Next, we shall look at two examples for non-resident foreigners who are on short-term business assignments in Singapore but were unable to leave Singapore due to COVID-19. In this graphic here, we have John, who is a non-tax resident foreigner who is not based in Singapore. As you can see, John was temporarily in Singapore for some time, and let's find out why. John is a non-resident foreigner. He was in Singapore for a business assignment from 1st March and had intended to leave Singapore immediately upon the completion of the Singapore assignment in April, which was 50 days later. However, due to COVID-19, he had to extend his stay in Singapore for another 20 days. During these 20 days, he continued to work remotely for his overseas employer. The last point here is actually a qualifying criteria, which is that the work done during his stay was not connected to the earlier business assignment in Singapore and would have been performed overseas if it were not for COVID-19. How will John's income while working in Singapore be taxed? For the answer, you will need to visualize on this graphic here that the blue bar actually represents 50 days of his original stay in Singapore plus another 20 days of extended stay due to COVID-19. Based on the quantitative test, John is considered a non-tax resident because his total stay in Singapore is less than 183 days. He will not be considered as exercising an employment in Singapore during the extended stay of 20 days because he has met the two qualifying criteria. 1. The period of extended stay of 20 days was not more than 60 days. 2. The work done was not connected to any business assignment in Singapore and would have been performed overseas if not for COVID-19. As for the first 50 days, that employment income will not be taxed because going by normal tax rules, if a non-tax resident foreigner's period of stay or employment in Singapore is 60 days or less, that employment income will be exempt from tax because these are short-term and temporary stays. Well, you may wonder, what happens if the extended part of John's stay was, say, 90 days instead of 20 days? Would John then be taxed on the extra 90 days in Singapore? Well, we have the answer in the next two slides. So here we have John on the graphic, who instead of 20 days stayed for 90 extra days in Singapore due to COVID-19. We will keep all other facts the same as in the previous example. For instance, John was originally in Singapore for 50 days for a business assignment. The only difference is that John extended his stay in Singapore by 90 days instead of 20 days due to COVID-19. As in example 1, he continued to work remotely for his overseas employer during his extended stay, and yes, the work was not connected to any business assignment in Singapore. If we add the original 50 days and the 90 extra days due to COVID-19, John would have stayed 140 days in Singapore. Since he has resided or worked in Singapore for less than 183 days, John would still be assessed as non-tax resident. Since John's extended stay is 90 days, which exceeded the COVID-19 tax measure of additional 60 days, his income for the full 140 days will be subject to tax in Singapore under normal tax rules. His income for the 140 days will be subject to tax in Singapore at the flat non-resident rate of 15% or resident rates, whichever is higher. And of course, John may be taxed twice, both in Singapore and overseas. If there are double tax treaties with John's country and Singapore, which is highly likely, John may apply for tax reliefs. If you are wondering how can employees like John and Andrew and their employers apply for these COVID-19 tax measures, well, no application is needed. Employers and employees who are based overseas can simply report to IRAS the part of income that is taxable in Singapore after taking into account the COVID-19 tax measures. Regardless of whether income has to be reported, all employers and employees should ensure that they meet the prescribed conditions and must be able to substantiate claims upon audit or query by IRAS. It is also mandatory to keep sufficient documentation with details in order to substantiate employees' stay in Singapore, as well as the reasons for the extended stay in Singapore. In the next couple of slides, we will present our answers to some common questions before we move on to our last agenda item. As you know, overseas-based Singaporeans or PRs like Andrew here who returned to Singapore due to COVID-19 must fulfill two criteria in order for them to be considered as not exercising an employment in Singapore. And one of them is that the contractual terms governing their employment must remain unchanged. So the first question here is, what is considered a change to contractual terms? For Singaporeans or PRs such as Andrew here who are based overseas, their overseas allowances such as costs of living and accommodation may cease when they returned to Singapore. Would the cessation of these overseas allowances be considered as a change in their contractual terms governing their employment? The answer is no. The cessation of such overseas allowances would not be considered as a change in their contractual terms governing their employment. The second question is for people like Andrew who returned to Singapore. If he was served with a stay-home notice or quarantine period, would that count as part of the employment in Singapore? So here's the question. An overseas-based employee was required to serve out the 14-day stay-home notice or quarantine period in Singapore. Would this period be considered as part of his work days in Singapore and also when determining his residency status? The short answer is no. If the employee has to serve out a stay-home notice or quarantine, and as a result of which would not be allowed to perform any work in connection with his Singapore assignment during the period, it would not be included for the purpose of counting the number of work days in Singapore. It would also not be counted for determining his residency status. However, employees must keep relevant supporting documents for these notices and forward them to IRAS upon request. We will now move on to the last agenda item on the tax treatment of employment benefits received by employees due to COVID-19. And we believe that this will be of interest, especially to employers who are providing employees with extra allowances due to COVID-19. As you all know, especially those of you who are familiar with the Form IR21, all employment income as well as benefits in kind that an employer may provide are taxable unless they are specifically exempted from income tax or granted administrative concession. Generally, employers may provide employees, especially foreign employees, with benefits such as accommodation benefits, as well as allowances for food, transport, or daily expenses. And these are all taxable under normal tax rules. Now, we have observed that there are four main types of accommodation benefits. Let's take a look at how these benefits are currently taxed. Firstly, employers may rent a property for the employee, in which case the total rent paid by employers will be taxable since the employee would have benefited from the accommodation. If the employee has paid any part of the rent, that part can be deducted from the amount brought to tax. Employers may also allow employees to stay in a property owned by the employer. In this case, the employee who benefited from such accommodation will have to pay tax based on the annual value of the property less the total annual rent paid by the employee, if any. The third type of accommodation is a hotel stay. In this case, it is quite straightforward. The employee will be taxed based on the actual costs incurred by the employer for the hotel stay, less any part of that amount that was paid by the employee. Finally, employers may decide to give employees a housing allowance and leave it to employees to arrange their own accommodation. In this case, this allowance will be taxed in full. Now, as for the second type of allowances, which are allowances for food, transport, or daily expenses. These fixed allowances, whether for meals, transport, or daily expenses, are currently reported and are taxed in full. However, if employees are working overtime and employers provide meal allowances and reimbursements as a result, these OT benefits are generally not taxable, provided they are for working beyond official working hours on an ad hoc basis, and this payment policy is generally available to all staff. However, we recognize that due to COVID-19, things are a little different. Employers have been providing employees with extra benefits and support on top of what they usually get, especially if their employment is disrupted by COVID-19. And these are due to movement restrictions being imposed within and across borders due to the COVID-19 pandemic. Employers may have also provided accommodation and other types of benefits to support employees who are affected by such circumstances. Hence, tax exemption has been granted for such extra benefits. And the exceptional treatment is to recognize that affected employees received such benefits from their employers due to exceptional circumstances, such as Malaysia's Movement Control Order. Hence, there are tax exemptions for accommodation, food, transport, and daily necessities benefits that employees have received in calendar year 2020. However, there are some specified limits and conditions that we will be going through in the next few slides. So firstly, what benefits can potentially qualify for these tax exemptions? Cash allowance, reimbursements, or benefits in kind for accommodation in Singapore, including furniture and fittings provided together with the accommodation, will be tax exempt. Cash allowance, reimbursement, or benefits in kind for food, transport, and daily necessities for consumption in Singapore will also be tax exempt. Now, as mentioned, there are some conditions that must be satisfied in order for these tax exemptions to apply. And there are actually two main conditions. The first condition will relate to an effective date, while the second condition will relate to business continuity and health and safety. So here are the qualifying conditions, and there are two, A and B. For condition A, the employee must not have ordinarily received such benefits in Singapore before 1st February 2020. But refer to the footnote here. For benefits for food, transport, and daily necessities, if the employee has received these benefits on or after 1st February due to reasons that we will show you in condition B, such benefits will qualify for the exemption even if the employee has received similar benefits before 1st February due to work exigencies. For condition B, it relates to supporting business continuity and health and safety. To qualify for the tax exemption, the employer must have provided the benefits either because the employee normally resides outside Singapore but is required to reside here during the COVID-19 pandemic to ensure continuity of his employer's business during the pandemic, or the provision of the benefit will reduce the risks of COVID-19 infection for the employee and/or will reduce the risk that the employee will infect others. Now that we have established these qualifying conditions, let's touch on how much will be exempted. First, let's talk about the benefits relating to accommodation, including furniture and fittings provided with the accommodation. The amount of cash allowance, reimbursements, or value of the accommodation, including furniture and fittings, exempted from tax is subject to a total cap of $75 per day per employee. Next, we have benefits relating to food, transport, and daily necessities. The amount of cash allowance, reimbursements, or value of benefits for food, transport, and daily necessities exempted from tax will be subject to a cap of $50 per day per employee. And we would like to add that this $50 cap is applied on the total amount provided, whether this amount is categorized as food, transport, or daily necessities. We will now provide two case studies to illustrate how these work. The first situation here is quite common, considering COVID-19 travel restrictions. Here we have an employee, Stephen, who lives in Malaysia and who has been traveling in and out of Singapore for work every day. But because of COVID-19, his employer has been reimbursing him for a hotel stay here. So here's Stephen's story. Stephen lives in Malaysia, but has been traveling to Singapore for work on a daily basis since 2 years ago. Due to Malaysia's lockdown, his employer arranged for him to temporarily stay in a hotel in Singapore for 2 weeks in March 2020. Stephen was reimbursed by his employer for the cost of his hotel stay of $90 per day. So in this case, will Stephen have to pay tax on the $90 that he receives from his employer every day? The short answer is that Stephen will only be taxed on part of that $90 due to COVID-19 tax measures. Now, if you recall, the first $75 worth of cash allowance, reimbursement, or value of the accommodation will be exempted from tax for each employee under the COVID-19 tax measures. So let's work out how much Stephen will actually be taxed. Firstly, we will take the length of Stephen's stay in the hotel, which was 2 weeks or 14 days. The total cost for his full hotel stay was 14 days times the $90 hotel stay rate, which was $1,260. Since the first $75 will be exempted, the total amount exempted would be $75 times the 14 days, which means $1,050 will not be taxed. Hence, Stephen will have to pay tax on the excess benefits of $210. The second case study that we have here is that we have employees who were provided with cash allowances for food and transport. Let's take a look to see how this cash allowance would be taxed. Company A is in the business of providing essential services. During the circuit breaker period from 7 April to 1st June, the company provided a one-time cash allowance of $500 to each of its employees who supported business operations in its office. And just to highlight again, the company has stated the period to which this allowance is applicable. And this was a one-off cash allowance meant to cover the entire circuit breaker period from 7 April to 1st June. This payment is to subsidize employees' food and transport expenses. No such benefits were provided to these employees before, except when they had to work overtime occasionally. And this last point here is particularly important, as one of the qualifying conditions of the COVID-19 tax measures is that employees must not have ordinarily received such benefits in Singapore before 1st February 2020. Now, in this case, would Company A's employees have to pay tax on this $500 cash allowance? The short answer is no. If you recall, the amount of cash allowance, reimbursement, or value of benefits for food, transport, or daily necessities exempted from tax will be subject to a cap of $50 per day per employee. So the total number of days from 7 April to 1st June that the $500 was meant for is 55 days. The total amount of cash allowance that employees received during the period was $500. So to work out the total amount of cash allowance that would have been eligible for tax exemption, it would be the $50 cap times the 55 days. Since $500 does not exceed this eligible amount, employees of this company will not have to pay tax on the $500 cash allowance. Now, there may be employers, like in the previous example, who prefer not to provide allowances on a daily basis and instead decide to provide a one-time cash allowance in lump sum. Here is another example of how the $50 or $75 threshold would apply. For lump sum cash allowances, employers should state the period to which the allowance is applicable, so as to determine whether the amount meets the exemption threshold on a per-day basis. Well, let's illustrate this with an example. Let's say an employer provides an upfront cash allowance for accommodation of $5,000, and this covers accommodation costs from 1st March to 30 April 2020. And as you know, the tax exemption threshold per day for accommodation is $75. Since there are a total of 61 calendar days in March and April 2020, the amount of tax exemption that the employee can qualify for would be $75 cap times 61 days, which means $4,575 will be exempted from tax. Hence, the employee will only be taxed on the difference between the original $5,000 and the $4,575, which is $425. So in this case, just $425 will be brought to tax. Now, before we move on to 4 frequently asked questions in the final section of this webinar, we would like to take the opportunity to go through some specific items that may or may not be covered under these COVID-19 tax exemptions, beginning with benefits relating to accommodation. Firstly, the tax exemption will cover that part of the benefits relating to furniture and fittings in the accommodation if it is furnished, subject to the overall cap. This means that if furniture and fittings are provided to employees on their own without the provision of accommodation, the furniture and fittings would not be covered within the exemption. Thirdly, an employee who received accommodation benefits in Singapore before 1st February 2020 cannot qualify for the exemption on accommodation. Next, here are some specific items that we would consider as part of the total allowance provided for food, transport, or daily expenses. Firstly, the total allowance for food, transport, or daily expenses would include transport benefits provided for employees to travel from home to office and vice versa, or travel from home to an alternative workplace as part of business continuity plans for purpose of reducing the risks of COVID-19 infection for the employee and or the risks that the employee will infect others. Secondly, the total allowance for food, transport, or daily expenses would include any meal payments and food provided to essential staff who are working in the office premises during the COVID-19 period. We will now wrap up this recording with some FAQs. One question that we often get is, what happens if instead of rented apartments and hotels, employees are allowed to stay on a company's own premises? Would the $75 per day threshold still apply? So here's the question. Due to Malaysia's lockdown, we arranged for our Malaysian workers to stay temporarily in our company's own premises with no additional costs incurred. Is this benefit taxable? And the answer? IRAS is prepared to accept that the value of accommodation provided here is not more than $75 per day in this case. Therefore, the benefit will be exempt from tax. Now, you may know of employees who were on leave of absence or stay-home notice. Some employers have provided allowances to cover their accommodation and meals during this period and would like to know if these allowances are taxable. So here is the question. Due to COVID-19, my company provided an allowance to cover the accommodation and meals for employees who were on leave of absence or stay-home notice. There is no other COVID-19 related allowance given besides the above. Is this allowance taxable? Assuming that this was an allowance that was given to employees in one lump sum, then the company has to state the allowance that is applicable to accommodation and meals respectively. the daily cap of $75 per employee for accommodation allowance and the daily cap of $50 per employee for daily allowance will have to be separately applied to each of the allowance to determine if there is any balance remaining to be taxed. Now let's take a look at this company who has provided a one-time allowance of $2,000 in March 2020 for every employee to subsidize costs relating to this list of expenses that you can see here, from protective equipment to childcare expenses, transport expenses, and even medical costs relating to COVID-19. Now, would this one-time allowance be taxable? You would notice that this $2,000 allowance meant for the month of March covers expenses like transport and daily expenses. So the answer is that only the items on transport and daily necessities will be covered under the tax exemption. Let us explain why. So here's the answer. Only the items on transport and daily necessities are covered under the tax exemption. Other items like child or dependent care expenses and work from home expenses are not covered. The company needs to state the period to which the allowance is applicable and apply the cap of $50 per day per employee for items categorized under food, transport, and daily necessities in order to work out what will be taxed and what is tax exempt. For this question, we assume that out of the original $2,000 allowance, $1,500 is actually for transport or daily necessities. So if we could refer to this computation here in this table, the $1,500 is actually for the period 1st March to 31st March, which is 31 days. So we can work out that $1,550 would have been eligible for tax exemption since that is the $50 cap times 31 days. As the allowance of $1,500 for transport and daily necessities is less than the amount eligible for tax exemption, employees will not need to pay tax on the $1,500 part of the allowance in this case. And now for our final slide. We have done up a case study which we believe most of us would be able to relate to. Since many employees are working from home during this period, some employers would provide cash allowances to subsidize their home utilities and bills. Let's find out if this cash allowance can qualify for the COVID-19 tax exemption. So the question goes, during the circuit breaker period, my employer provided a one-time cash allowance of $200 for each of the employees who are required to work from home. The allowance is to subsidize the employees for additional home utilities expenses incurred when working from home. Is this allowance taxable? Now, if you recall, we have always talked about benefits relating to accommodation, food, transport, and daily necessities, and never about utilities. So the short answer to this question is yes. This benefit does not fall within the types of benefits that qualify for tax exemption. Hence, the $200 will be taxable. Employees may claim tax deduction on additional electricity and telecommunication expenses incurred when working from home. With that, we have come to the end of this recording, and we hope that the information and case studies have been useful. We will now move on to the Q&As. Thank you for your time.